end of October to mid-March, this 5.5 month period, 53% in about a little over 5 months. That's insane. And then ever since then, it's been kind of going sideways, really since February. But this move is what I really want to talk about. Like that was so if you zoom out a little bit more, 5 years, bam. Okay, so obviously everything went down during the pandemic, from like end of February to March, end of March, late March. Everything went down. Everything, all the businesses shut down, so it makes sense. But then this run was just incredible, and then it bounced back like everything else. Although the S&P 500 actually had a better bounce immediately off the March lows. But then the rest of 2000 really took off, like I said, at the end of October. Anyway, so what's the big deal? What is the Russell 2000? I think it's a little bit overlooked, actually, underappreciated. Everyone's always so focused about the S&P 500, the Nasdaq, and the Dow. Don't even get me started about the Dow, but it is what it is. But the Russell 2000, it's a small cap index, primarily consisting of U.S. based companies or companies that do most of their business within the U.S. and it's often seen as a leading indicator. So it has a track record of foreshadowing what's going to happen with the S&P 500. It's not down to a T, but like that's how it's typically viewed. And I think part of the reason is because it has a highly cyclical nature to it. So if you look at what it's composed of, let me just do some rough math here. So financials 14.6, industrials 14.1. So these are two sectors highly sensitive to the economy. So that's 28%, 29, 40. Let's just put energy in there. 44, 47, 48, 48% exposed to cyclical sectors, as opposed to the S&P 500. It's about 35 something, 30. Let's just say 35%. So 48 versus 35%. So much more exposed to the ebbs and flows of the economy. And so let's see the track record about it leading the S&P 500. Let's go back to 2018. It peaked around end of August 2018 and went down, corrected during the trade war rhetoric. Or not it was the trade war, but also Fed Chair Powell said the Fed was on autopilot, and that kind of spooked the market. Anyways, it peaked around end of August, while the S&P 500 peaked a month later, September, end of September, late September. And then coming out of the pandemic. Okay, so coming out of the pandemic, its leading indicator status, this is where it gets a little shoddy, just because coming out of the pandemic, it was those growth stocks, stay-at-home stocks that really led the way, like Peloton, Zoom Video, Netflix, just because that's what people were really doing. That's what they could do. And so those stocks led the way coming out, which explains why the Russell 2000 really struggled out of the gate. You see over here, end of October, it wasn't even close to hitting an all-time high, while the S&P 500, I believe, already did. But yeah, so you look here, Russell 2000 bottomed, I think, March 19th. So it was a few days before the S&P 500 on March 23rd. But then it did retest it on March 23rd. But then coming out, it was just slow. And that's just because of the how the pandemic shaped the economy. It just made it even more technology based. So if you look at the S&P 500, it's the technology sector is like 28% of it. So the economy really is technology these days. So is that going to affect the S&P, Russell 2000's leading indicator status? I don't know, but it could be something interesting to watch moving forward. And so I want to bring your attention to this graph that I saw here. I was just fumbling around the Russell 2000, and I just drew some lines, and I just want to let you guys know I'm not a technician, I'm not a macro trader. I'm really just a guy who religiously follows the market since 2018. It's partly because it's my job to watch the market all day. But so take this with a grain of salt. I'm not a financial advisor. I'm just a guy who drew some lines and makes just putting my ideas out there. So you see this. This is a monthly chart of the Russell 2000. Bottom here in 2009, March 2009, after the global financial crisis. You see this nice uptrend here. I'm not sure what those technicians would call it, but I thought it was pretty cool. Looked pretty legit. And so the market has a tendency of overshooting to the downside and to the upside. And I think that's what we saw here. It really overshot the downside during the pandemic. Understandable. People thought the world was going to end. And then it just makes a swift recovery as people realize, oh, wait, the world's not ending. Businesses are going to reopen. There's a lot of progress being done on the medical side of things to not only detect the virus, but also treat the virus and then eventually prevent the virus with a vaccine. That was part of the whole reopening thesis. And I really favored cyclical stocks, obviously, because the economy's doing nice. It's doing nicely, or better than expected, much better than expected. And so the Russell 2000 being a index heavily exposed to cyclical sectors of the economy, it did really well. And this is where I think it overshot. Back when from that end of October period, right here, this is where it started, end of October. And that 5-month period, it took it right there. That's insane. And then and then it's been stuck in a consolidation phase, kind of going sideways since February, really. And so this kind of looked crazy. I was like, wow, this thing must come down, right? Like something like this? Possibly. I don't know. So that's what I kind of wanted to discuss here. So is it overvalued? That's the question. You can make an argument it's going to go down if you think it's overvalued. Although, the market can stay solvent, or if the market can stay irrational longer, then you can stay solvent. But talking about valuations, this can be a little tricky with the Russell 2000 just because a lot of the companies, they tend to be smaller and they tend to be money-losing companies. So the latest stat I could find was this right here from Market Watch, an opinion piece citing the source from FactSet, saying over 30% of companies are not profitable. This is based on the prior 12 months. Okay, so based on the PE ratio, this is what I found. This guy's he has a really nice chart here. I'm not sure what his source is. Jordani, I don't know. But this is a forward PE, so instead of trailing, it's the next 12 months, I'm assuming. He has a PE ratio of 29.6 for the Russell 2000. So what you want to know is how does that compare to a historical chart? And here it is right here. So this is where we are on July 1st. And as you can see, on a historical basis, we seem to be overvalued. Like I said, the market can stay irrational longer than you can stay solvent, so the saying goes. It really overshot it here immediately coming out of the pandemic, and we've kind of come down here as the Russell 2000 has tracked sideways. And so based on this, you can make an argument it could come down a little bit more, the PE. Whether that be we just continue tracking sideways, I think that could also do it. Which means like the Russell 2000 may not necessarily correct in the next few months. But it could be tricky because if you look on these websites here, this is for the iShares Russell 2000 ETF. It has a PE ratio of 20.9 as opposed to this right here, which is 29.8, and this one from Morningstar, 16.3. Okay, bit of a caveat here. I believe these are trailing 12-month PEs, and remember what I said, more than 30% of the companies in the Russell 2000 don't have a PE ratio because they don't have any earnings. And so when you include companies that don't have any earnings, a zero, it kind of brings down that PE ratio, making it seem like it's undervalued. So I think you should take PEs with a grain of salt, especially the ones you see here. This one is a forward PE. I'm not sure if this calculated those money-losing companies. But I tend to go with this chart right here, this forward PE one. It seems more realistic than the ones you find on websites for the Russell 2000. So I think you should take PE. What I'm trying to say is you should take these PE ratios from the Russell 2000, mainly with a grain of salt, because it does contain a lot of money losing companies, which makes it hard to value, I think. Another way to look at it is like, what is the Russell 2000? What are its biggest components? Well, we got AMC here. So if you just look right off the bat, oh, AMC, top weighting component. It's a fraud. It's a meme stock. It has to go down. Um, well, it's an index, so it's very well diversified. It's only point AMC is only 0.67% of the company or of the index. As you can see, it's not that. It's just a fraction of what the Russell 2000 is comprised of. So take that with another grain of salt. Okay, so back to this chart. So I do have exposure to the Russell 2000. I invest passively in my Roth IRA. So this is my history with the Russell 2000. I'm actually quite up a decent amount, 58.7%, including dividends. Without is 54.1%. And I started investing right when the S&P 500 really took a 10% or corrected by 10% in February 2018. I think that was because of the trade war rhetoric with Trump. So, anyways, I just started buying every 2 weeks really in my IRA, um, just dollar cost averaging really. But the thing is, I haven't bought a share of that Russell 2000 ETF since October 26, 2020. 2020, remember, that's right here towards this bottom of this ascending line. And I've been putting money every single month in my account, and I just haven't been putting money in the Russell 2000 just because of the appreciation. The appreciation has just outpaced my monthly contributions to the point where I was still overweight even after I was putting money in there, and now finally I'm equal weight. And so I'm like, okay, next month or end of this month, it might be time for me to finally buy some more of the small cap index. And so I was like, okay, let me just look at the chart, and this is what I found. It's like, wow. I mean, either way, even if it goes down, I'm still going to be putting money in there. But I mean, I think it's just a pretty sage or wise strategy. But if you actually hold stocks in the Russell 2000, so this right here, this green line is about like 8% lower from where we are right now. So well, it's not big. It's totally possible to happen in the next couple months. Down 8%, that's nothing. But then once you start getting down here, then it starts getting a little bit more scary. But even if it does correct, it's right here. I'm in May 2022 right here. Um, it's still totally within the upwards trend here. Like it's still bullish, I think. So I think we can definitely see a healthy correction in the Russell 2000. I would love to buy more over here between these two green lines. But the question is like, what's going to cause it to go down? And I think there's several things. I think the main thing is the Fed. The Fed Jackson Hole was like, is that in August, like around here or something? It may decide, we're going to start tapering asset purchases, and people already know they're going to start tapering asset purchases, but people don't know by how much. Right now, they're buying $120 billion in assets, mortgage-backed securities, and treasuries per month, cumulative. And they could decide to taper that by more than expected, maybe go down from 120 to like 60. I don't think anyone's expecting that. I think many people are expecting 120 to like 100. It's still a dovish policy, but they can you surprise and say, the economy is getting a little overheated, even though you see some of the data starting to moderate. There's peak growth concerns that growth rates aren't going to be what they used to coming out of the pandemic, we saw right here. And so with this peak growth narrative, that growth rates are slowing down or moderating. And a byproduct of that would then be inflation. If growth moderates, inflation is apt to moderate too. So, and then with the Fed coming out and saying, hey, we're going to taper by more than what you guys think, I think that can really catalyze a healthy pullback here within mid 2022. So it's just some food for thought. But anyways, yeah, thanks for watching. Have a great day.